Welcome to Multifamily Financing 303. My name is James Eng with Old Capital. And in this webinar, I'm going to go through how to close a deal in less than 60 days. And multifamily investing is like a marathon, as you have to be persistent, well-trained, but at times you need to sprint. So in DFW, most deals are requiring you to close in 60 days. So you must be able to meet this timeline in order to win deals in today's market. So in this webinar, I'm going to show you how to sprint. I don't know if I'm going to get you as fast as Usain Bolt, but we're going to try. So I'm going to take you through a case study of a deal and all the things, all the items that are going to come up throughout your transaction, day by day, week by week, so that you can meet the target closing date. In addition to going through a case study of a deal and the timeline, I'm also going to introduce you to one of our borrowers, Satya Messina. So he has closed over 5 multifamily transactions with full capital, and he will share his story with you. And then to wrap up, after the borrower spotlight, we will have reasons why people use Old Capital, and then how to connect with us through the podcast, Facebook, and conference. And if you have any questions, please type them in the chat box and we will answer them at the end of the presentation. And then also, if you have not seen 101 or 202 multifamily financing, you can go to oldcapitalpodcast.com and click on the links there to review those. And so to get started, I really wanted to just give you a little bit of background on myself. So I was born and raised in Houston, Texas, went to school at UT in Austin, and then have lived in Dallas now for the last 12 years. And so my background is really from a risk standpoint. So I was a loan underwriter at GE Capital for 8 years and underwrote over $750 million in commercial real estate loans. So everything from office, multifamily, industrial, self-storage, I underwrote it for their bridge program. And then in the last 3 years, I have specialized in originating multifamily debt. So I've done about $450 million in multifamily loans in the last 3 years. And then in addition to lending on multifamily properties, I also invest as a limited partner in multifamily. And so I'm currently investing in 20 properties across 5,000 units in DFW, Austin, and San Antonio. So just in total, $1.2 billion in commercial real estate transactions, and then also an investor in over 5,000 here in Texas. So understanding how to structure the debt, but also how to appeal to equity investors, as I see a lot of transactions coming across my desk, is one of the main advantages that people will use me for debt. So before you can really sprint, you have to get a deal under contract. And so you need to submit a offer on the property. And your offer is going to really consist of 4 things. Number 1, your letter of intent. Number 2, your proof of funds. Number 3, your resume. And 4, the loan term sheet that we can provide. So number 1, your letter of intent. That's going to outline purchase price, earnest money, due diligence period, time to close, any extension options. Number 2, your proof of funds. So that's the cash available from the KPs to close the deal. So a lot of people are doing syndications, but it gives the seller a lot of comfort if you can show bank statements, or if you can show your 1031 exchange account that has cash ready to go in case the syndication does not raise all of the equity. And third is your resume. So the seller wants to see, what deals you've closed so far. Do you own anything in the market? What other listing brokers have you worked with? What's your transaction record? The resume is very important in today's market. And then fourth is your loan term sheet. So have you reviewed your financial statement with a lender? Have they reviewed the property? And then what type of loan terms does the property qualify based on the cash flow? So a lot of buyers will ask me for loan term sheets once they've underwritten the deal, possibly toured it, and decided that they're going to make an offer on the deal. And this loan term sheet is going to show how the lender is underwriting the property's cash flows. In webinar 202, we covered how Fannie Mae really sizes loans to a maximum 80% loan to cost, or a minimum 125 debt service. And every lender is going to look at the deal slightly differently They're going to underwrite expenses a little bit differently. So you really have to understand, is this a reasonable term sheet based off of what you see in the T12, what you see in the rent roll? Is this a reasonable term sheet? And then the big thing right now is taxes. So understanding whether or not the lender is underwriting a reassessed number. So if your current, let's say your purchase price is 15 million and the current assessment is 7.5, then are they bringing taxes up to at least 70% of that purchase price? Because in Texas you can bring it all the way up the next year. And so you understand how you're underwriting taxes, insurance, and then also net rental. So net rental, some lenders will use a T1 and annualize that, and that has a little bit more risk as it has to continually go up or stay at that higher level throughout the closing process, or your loan proceeds could be cut. So in order for us to run a term sheet for you, we need a trailing 12 financial statement, a rent roll, offering memorandum or address of the property, and then the estimated purchase price and rehab. So you might go through many loan term sheets before getting your LOI accepted. And once the LOI is accepted though, and you are under contract, it really goes from the marathon to the sprint, right? For the next 60 days, you have to be ready to go and move quickly in the next 60 days. And so I wanted to show you sort of where we're going here on the webinar in terms of the deal closing roadmap. And so here's the timeline for the next 7 to 8 weeks, where we're going to spend the rest of the webinar discussing each week and what you should be doing during this time frame to get the loan approved on time and the deal closed. So at a high level, the PSA, purchase and sale agreement, is signed. Week 1, you want to get that loan application into the lender. Week 2, all the lender inspections will take place. Week 3, all the checklist items need to be done and completed by you and your sponsorship group. And week 4 is the loan underwriting. So this is when all the third-party reports come back in. This is when all your due diligence is sitting in front of the underwriter, and then they are putting it all together. So you can see that it's a pretty straight line, and then there starts to be some twists and turns here while you submit the deal for approval. So that might be taking the deal up to Fannie Mae, Freddie Mac. It might be questions back from their investment committee before sort of week 5, where you would receive the loan approval. So once you receive loan approval, lock the interest rate and close the deal. And so that is the timeline, and we're going to spend the rest of the webinar really drilling down on each one of these weeks. So in week 1, you sign the PSA, you wire your earnest money to the title company, and now the clock really begins. And so negotiating the PSA, sometimes people can get access agreements, but a lot of times people are having to go non-refundable day 1. And so if you do this, let's say you're putting $250,000 day 1, then most people are just starting the loan application process right then, day 1. But if you're in a market where you do not have significant hard money, you can complete your physical due diligence first and then submit the loan application towards the end of the first week if there's no surprises during your physical walkthrough. And so when you're submitting the loan application, typically you're filling out items on the loan application, and then also sending a expense deposit. And this expense deposit can be anywhere from $20,000 to $30,000. And this is really to engage the third-party reports. So your engineering, environmental, appraisal, and possibly a green report if you're trying to qualify for the Fannie Mae program. So on the right-hand side, you can see on this loan application, the loan was about $10.6 million, Fannie Mae loan, 12 years fixed, 4 years interest only, and the minimum debt service is $125. And so you see the asterisk near the interest rate. And so on Fannie Mae loans, this is just an estimate based on where 10-year treasuries are and where the spreads are. And so this is not going to be locked until later on in the process. And so week 2, your third-party reports will schedule their inspections during this week. And there's really 4 reports that you want to be looking for that the lender is going to be engaging. Number 1 is engineering. Number 2 is environmental. 3 is appraisal, and 4 is the green report if you're doing a Fannie Mae loan. So the engineer, they're going to be looking for deferred maintenance. They're going to be looking for large capital expenditures such as the boiler, chiller, the roofs, and they'll walk about 10% of the interiors. And then the environmental, they're really looking for any environmental hazards surrounding properties that could be impacting the subject property. And then the appraiser, they'll probably walk probably only 5% of the units, and they really want to understand the current financial situation of the property and understand where you're going to take the property in terms of your capex and improving the rents on that property. And then the fourth item will be the green report. So the green report is going to see if the property qualifies for the 25% savings in either water or electric. So while these inspections are taking place, the buyer is going to receive a lender's due diligence checklist that's going to detail all the items that are going to be needed from the lender. But I wanted to highlight a couple of the key items and why they're important. So let's start with number one, the organizational chart. So this shows what the borrower LLC is going to be, but then also more importantly, it's going to show who's the general partner of the LLC, and then what's the ownership percentage of the different key principals, and is there anybody who's going to own more than 20% of the borrower LLC? And if they are, then that person is going to require additional documents such as personal financial statement, schedule of real estate, bank statements. They're going to run credit on that person. So the level of due diligence is significantly higher for anybody with 20% or more ownership, or if they are a general partner in the borrower LLC. So the organizational chart is one of the first things they ask for. So getting that figured out in your sponsorship group is very important. Second is borrower counsel. And this is very important because a lot of the loan documents are going to be going to them. All the signature pages, we're going to go through them. So having a good borrower counsel assigned and ready to go, and know that the next 60 days they're going to be focused on this transaction is key. Number three is the insurance agent. So Fannie Mae is going to have certain requirements for insurance, and so you're going to need to get an insurance agent engaged and make sure that they meet all the Fannie Mae guidelines and are able to provide you two things. The Accords 25 and 28 are what the insurance agent will give you. It's basically the property and liability insurance coverages, and that will be submitted to the lender for approval. So get that as soon as possible, as that is a long lead time item. And then the fourth thing here on key items is the title commitment and survey. So on the right-hand side, you can see a survey of this particular property. And so the seller had actually done a Fannie Mae loan on this property already. And so it allowed them to reuse that same survey. And so if there's already a good survey, it's an Alta survey, it's been done recently, there's been no material changes, and the seller will sign a no change affidavit, then you can typically use the survey. But you need to ask for the survey early on in the process. Make sure you get that in your due diligence and send that to the lender for review. And if you are not able to get approval on the existing survey, the buyer needs to engage the survey. So that's anywhere from $4,000 to $5,000 and can take up to 3 weeks sometimes. So engaging that survey early on when the lender is engaging their other reports is key. And then the last two items here are your rehab budget and your year one pro forma. So the rehab budget is really needed by two people. The appraiser needs it to determine the as stabilized value, and then the engineer needs it because if you're going to be doing this work to the property, they don't want you to double count on your replacement reserve. And so they ask for that rehab budget up front. And then the year one pro forma, the appraiser wants to know two things. Number one, where are you going to take rents? So once you've done this rehab, where are you going to take rents? And then also, how are you going to run this property? Who's your management company? What's their management fee? But then how are they going to run payroll? How are they going to run repairs and maintenance? So these items very early on in the process, you got to get these items ready to go for these third-party reports because it can hold up the appraiser, which is going to hold up your underwriting later down the road. So you want to get these items ready to go and prepared for these third-party report inspectors. So going into week 3, the property inspections are done, they're writing up the reports. Now this is your time. So this is really for the borrower to be submitting all the property due diligence, the sponsorship information, the management due diligence. Some of the key items here that get people sort of stuck sometimes is around the sponsorship due diligence. So putting together your personal financial statement, making sure that ties out to your schedule of real estate. When you go through your schedule of real estate, if there's any property with, let's say, an LTV over 80% or a debt service under 125, then the lender is going to require an explanation. And so I would be prepared already. If you are preparing your schedule of real estate, if you do not have that, then you're going to need that information. Go ahead and request that information. You might only be a limited partner in that deal, but on your schedule of real estate, you're showing every real estate deal that you're a part of. And so go ahead and start asking the general partners for that information as you fill out your personal financial statement, because those questions are going to come on the schedule of real estate. We're going to need full bank statements. So the full PDF, all the pages. You're going to fill out your credit authorizations and then operating agreements. So this goes back to the organizational chart. So if you decide that you're going to have an LLC between you and maybe the general partner, or between you and the ownership structure, and you are a key principal, they will request operating agreements. So having all your operating agreements ready to go is key. The other things on here that I wanted to highlight is in that sponsorship due diligence, the sponsorship group, we've touched on this before, but the net worth of that sponsorship group needs to be greater than the loan amount, and the liquidity, post-close liquidity, greater than 10% of the loan amount. And that liquidity is proven up on those bank statements. And so you want to make sure that you have that within your sponsorship group to cover that. And then two other things that I want to point out on this page. In week 3, you want to make sure you're getting your insurance done on the Accords 25 and 28, because the lender is going to underwrite the exact insurance premium that you get approved. And so on the initial term sheet, they might have used $250 a door or $250 a unit or $300 a unit. If yours comes in at $400 a unit, they're going to underwrite exactly that insurance number. And so the sooner we know the insurance premium, the earlier we can let the underwriter know, the appraiser know. And so if we need to be more aggressive on other underwriting assumptions, that's a key item to sort of flush out very early in the process. And then also utility bills. So utility bills, the green report is going to need 12 months of utility bills. And so if you do not have that, it's going to be very difficult to qualify. And so making sure that you get those early on in the process is key. Ideally, you would have all of your due diligence submitted before the third parties come back. And so you want all your information into the lender in that week 3 at a minimum. And so in week 4, you've submitted your due diligence. The third parties have already gone out there, and now they've written up the report, and now you get the reports back. And so this typically goes to the lender. You typically do not see these items. They might share some of the items with you, but you're going to have to ask. And so a lot of the times these are draft reports when they come back. And so there's still some flexibility in them, but let me go through the 4 key reports and sort of what to be looking for. So appraisal, there's going to be 2 numbers that come back on the appraisal that matter to you: as is and as stabilized. So as is pretty straightforward. That's just your purchase contract, what it's currently worth. But then the as stabilized number, so that $17.6 million number, that assumes, okay, if you buy it for 15.3, and let's say this group was putting in $1 million in rehab. So how much is it worth after you've done the rehab and raised the rents? And that's the as renovated or as stabilized value. And that is the number that the lender is going to use for the max LTV or loan to cost on the deal. So if they could take 80% of that 17.6 million, then they could give you a loan at that high of a number, but it's also going to have to hit a minimum 125 debt service. So when I started at Whole Capital in 2015, 2016, we were typically at 80% loan to cost. But in today's market, interest rates have come up, cap rates have come down, and thus most of the deals right now are probably 70 to 75% loan to cost off of that as renovated number. The next report is on engineering. So engineering, this is the guy who went out, sampled probably 10% of the units, walked the entire property. He's going to note things called immediate repairs. And these are things like, as you can see on this report, they have sidewalk, they have one down unit, they have some railroad ties. A lot of times they'll pick out like parking lots. Other times they'll touch on like fencing. So this is on a B and C property, immediate repairs, you're probably looking at 25 to 30,000 is typical. Some people get hit with aluminum wiring. Some people on older properties, maybe on the electric panels. So stab lock panels, those would be large immediate repairs. So when you're walking the property, understanding what the immediate repairs are, because those will be escrowed at 125% of cost. And so on this, it's 15, 16,000, and they'll do probably escrow about 20,000 to make sure that you have enough to do these reports or do these repairs. And you typically have 6 to 12 months to fix these items. And then the other piece of the engineering report that you have to be mindful of is the replacement reserve. And so they're going to look at, in the next 12 years, how much is it going to cost me to maintain the current status of this property? And so on this deal, they thought it would cost about $500,000, and they inflated it for about 3% over those 12 years. So their total cost was $624,000. Okay, and then they divide that by the number of units, and their replacement reserve came out to about 290 per unit. And so when you get the engineering report, you're going to look at the immediate repairs, and then you're also going to look at the replacement reserve. So the two key items that are going to impact, number one, your closing statement, but then also number two, your NOI. So when a lot of people are underwriting $250 a door, that's great, but if it's not realistic on a B and C property, it's probably closer to $300 a unit, unless you're doing a large rehab. And so if a lot of the items that would be on a 12-year schedule were on your rehab budget, then you would be covered, and that replacement reserve would probably be lower. Next is the environmental. So on most reports that I've seen come back, most of the multifamily properties do not have an issue here. So this is what you want to see on your phase one, is that there was no evidence of RECs or RECs. So recognized environmental conditions. This just essentially means that it's a clean property. If there are issues with the property, you would have to actually get what's called a phase two. And the phase two is going to be a more invasive study. The environmental person probably on a phase one sort of just walks around, just make sure that there's nothing materially happening on the property, and surveying the surrounding areas. Phase two might be they actually go on the property and drill holes and test groundwater. So that's not something you want to be a part of. But if there is an issue on your phase one, then you would have to get a phase two on the property. So those are the three reports: appraisal, engineering, and environmental. And the last report is the green report. So this is really specific for Fannie Mae. And so on this, you're going to get a report back that's probably 20 or 30 pages, but there's one chart that really matters. And that chart shows what percentage savings you're going to get or achieve by changing out certain things. And so you have to hit 25%, and most people are doing that through the water savings. And so on this one, essentially they're having to do faucets, shower heads, toilets, and irrigation. And so once you're able to do all that, on this deal, it was probably closer to $80,000, $90,000. They will escrow that at 100%, and then you'll have to do that in the first year. And so that'll allow you to qualify for the green program, which will give you an interest rate savings of anywhere from 10 basis points all the way up to 33 basis points, depending on the size of the deal. So this next slide, I love this next slide. Week 4, the underwriter, which was my job for 8 years at GE Capital, is essentially gathering the third-party reports, all the submissions you've done in terms of your personal financial statements, all the rehab budgets, all that stuff, and they're putting it together in a package and submitting it for approval. And so the underwriter could have questions. There could be pushback from Fannie Mae, from Freddie Mac. So this loan approval process can take time. And the earlier you get everything into the lender, the better, because this will allow them to work with the appraiser, possibly work with the engineer. So once you get the deal finally approved, that is when you are out of underwriting. And so important thing to note here is a lot of borrowers can sometimes get stuck on like checking in with the lender, seeing what else they need. But at this point, at some point, everything is submitted, and really your focus, we haven't really touched on this, but on the equity side of the equation, you really need to be, your bank account should be open already. You should already be receiving funds from limited partners, getting all their paperwork, getting their signed PPMs, getting their LP signatures, all that stuff now, while after you've submitted your due diligence into the lender. And so making sure all that stuff is done so that once you receive word of your loan approval, you are ready to close. And so this part is important. You're going to have to be responsive in getting any questions. They're going to have questions on your schedule of real estate. They're going to have questions on your rehab budget. So responding to those in a timely basis is key. And so once you receive approval from the lender, they will send you what's called a loan commitment. And this loan commitment, so on the right-hand side, outlines the terms. So on this loan, 10.8 million, 12-year term, 30-year amortization. And in order to take the approved loan terms and move them into a interest rate lock, you have to do all these items in terms of signing the commitment. But the big thing is the good faith deposit. So the good faith deposit is anywhere from 1% to 2% of the loan amount. And so this can be, depending on the loan size, a pretty big number. So on this deal, it's a $10.8 million loan, 2% good faith deposit, so $216,000 that the general partners are going to have to put up. If they've raised the money, they can use that money, or if they have not received all the funds, they can put up the money. And so this good faith deposit goes into the lender, and once you have received the loan commitment, the good faith deposit has been received by the lender, and then two other things in terms of locking the rate. All the searches need to be done. You need to finalize your operating agreement with all the LP signatures, and then also your insurance needs to be approved. So once you receive the loan approval, the important thing is review the terms, make sure everything looks good. Again, as you notice on the right-hand side, there is no interest rate on this loan commitment because it is not set yet. And so they are estimating that loan amount based on the interest rate of that loan commitment date. And so once they send that to you, you need to move quickly, sign the loan commitment, get the good faith deposit in, and make sure all the searches are done, all the rate lock items are complete. And so once you've sent in the good faith deposit, everything's been approved in terms of searches, in terms of your title pro forma, your survey, insurance has been approved, then the lender will go out and actually lock the rate. And so this is very specific to an investor. So they're going to go out and bid this loan out and get the best possible rate for you based off of not only the 10-year treasury, but the spread between the 10-year treasury and what that current loan amount with those terms is trading for. So on this deal, we ended up at 10.8 million, 4.81% interest rate, and then 4 years interest only. with yield maintenance until the end of the term, essentially the last 3 or 4 months. And so pretty standard terms, good rate lock, and in terms of the loan commitment, once you're able to lock the rate, now they are able to give you that final loan amount because they know the net cash flow has been solved for, all that underwriting has been done already. They have the interest rate, so they know exactly what you need on terms of your loan amount. And so after locking the rate, the lender will send funding numbers to the title company. And so these funding numbers, we'll go through them on the right-hand side. So I wanted to walk through the settlement statement. So on this example, the purchase price of this property was $15.2 million. The buyer put in $325 day one earnest money. They got a credit for real estate taxes and also prorated rent. And then the seller transferred security deposits of $33,000. And then we got them a loan of $10.8 million. There was a loan origination fee of 1%. They escrowed insurance and real estate taxes. And then they got $54,000 of their good faith deposit back at close. And they'll get the remaining back about 30 days after closing when the lender actually sells the loan to Fannie Mae. The CapEx reserve of $625,000, that is a combination of the capital rehab that they're doing to the property, but then also their green repairs and immediate repairs. Interim interest. So most deals are not going to close. So let's say it closed today at the end of August, then the first payment wouldn't be in September. It would be at the beginning of October. And so that interim interest is paying for that month in between. And then you have title fees, borrower counsel fee, lender counsel fee, and then you are paying your insurance for the first year at closing. And so all those numbers you have to build into your estimated settlement statement. This is just an example of a deal, pretty standard Fannie Mae deal. So you can use this as a template, but the buyer needed to come to closing with $4.8 million. And so if they were, let's say they were closing tomorrow, August 29th, if they were closing tomorrow, I would have them wire probably 50 to 100,000 more today. So 4.9 million wired to title on Tuesday, and then they would be closing on Wednesday. And that's for a couple of reasons. Number one, the down payment, these large wires typically need multiple approvers. And so you could walk into Wells Fargo at 9 a.m. and send your wire, but it might not get to the title company until 3 p.m. that day. And so if you do that the day of close, you will not close that day. And so it's very important to wire early so that the title company can confirm the wire. And then also the lender is going to wait till your wire hits the title company's account, and then they will fund their wire. And so the buyer funds Tuesday, the lender will fund Wednesday, and the title will fund out to the buyer and sellers, and on Wednesday to close the transaction. And so while the wire is important, the one other thing to keep in mind is during this last 2 weeks is signature pages. So you will not receive the full loan agreement. You will typically receive signature pages about 1.5 to 2 weeks before closing and right after your rate lock. So after your rate lock, you get your signature pages, and essentially that just is an attachment to the loan agreement. And so getting your signature pages, these are originals that need to go to the title company and the lender's attorney. So making sure that all your key principals are in the country or they can sign and send their papers is key when you're going to close a deal. And so making sure everybody is, at least in the US typically, we've done some deals where people are international, but it's already hard enough to close in 60 days. If everyone can be close to a FedEx, that helps significantly. So that is how you close a deal in less than 60 days. So it's a fast sprint, but at this point, once you close, you get to celebrate like Usain Bolt at the Olympics. So It's definitely a process. It's a lot of work in a short amount of time, and for most people, it is a little bit nerve-wracking. But I think if you have a bigger picture and understand sort of where you're going throughout the process, and sort of at any time throughout the transaction, you should always be asking you, like, what else could I be doing to move this process forward? And that will help not only your lender, but then also your equity partners. Because as soon as you know your interest rate, as soon as you know your loan amount, you know exactly how much you need to raise in terms of equity. And that just gives everyone a level of comfort. And so next up, I wanted to transition over to our borrower spotlight. And so I brought on Satya Messina. He's here in the office with me. I wanted to bring on Satya because he sort of came or started his multifamily journey the same time I did in 2015, and has essentially turned 8 units into more than 100, almost more. So I wanted him to tell his story. And so welcome on, Satya.
Thank you, James, for having me here. Again, Satya Masina here. Again, let me jump into my background a little bit. Been working in IT for last 19 years, in various different positions. Been with the same company for the last 14 years, making six-figure income. But just like many people out there, at some point I wanted to be financially independent, and I always wanted to do things on my own. So when that each starts, obviously you start exploring things. And I've explored many different businesses, primarily franchise businesses. I've explored multiple investment options. And based on the information out there, I was lucky enough to kind of figure out, this multifamily investing looked very, very promising. So once I kind of narrowed down on multifamily investing, it took time for me to kind of find that first deal, kind of get used to the idea of the rehab, buying not so attractive property and doing a value addition. So as you see here on the screen, my first property is an 8 units, basically 2 fourplexes next to each other. I found these on MLS. Typical, residential real estate mindset. I was looking on MLS, so found these and felt comfortable, and I've put in $140K of my own money and purchased this. And obviously, my first initial, I had no clue how to get a commercial loan done. And I approached, didn't have any commercial loan contacts, looked around, and basically, I went with the 2 residential loans. And I've also self-managed these 8 units. And I've learned a lot, with this property. And slowly figured out, the value addition and how the, as you keep increasing your NOI, how your valuation jumps in. While I was managing this property, my second property is with the experience right next year back in 15. A friend of mine and myself together, we bought this Elm Street Village, 37 units in McKinney. It's in great location, but the condition of the property was pretty bad. Like, I would classify this as a classic Class C property. But mustered up the courage to buy this. And again, I think even after 1 year of multifamily experience, I was at the same point where I could, I didn't know much about, how to put a commercial loan together. I mean, luckily, I was introduced to Old Capital, and it changed a lot of things for me. When I first contacted Paul Peebles at Old Capital, the first thing I got back is a white paper on commercial loans to kind of educate myself, and then I was referred to James Eng. And from a loan perspective, I never had to really look back since then. What I mean, just let me walk you through that process. So when I first contacted James, he walked the property with me, and he brought along a local banker that walked the property with me, and then within 60 days, I closed my first commercial loan. And in going back to my 8 units, so I sold my 8 units in 2016. Basically had 150% ROI within 2 years. And with this property with Elm Street, I've also turned this around in 2 years. And as you can see here on the screen, we did a 1031 exchange, basically exchanging into 3 different deals, and all of them have been Fannie Mae loans. As James went through the Fannie Mae loan process, I had to do 3 races in parallel. Basically, all of them have been executed parallelly. All of them are Fannie Mae loans. From my proceeds from 137 units to I went and bought 87 units in one shot. So I think without World Capital and James Eng's support, probably, and without their expertise and kind of hand holding through my first bank loan, and and doing 3 Fannie Mae loans at the same time is not a joke. So basically, when you work with Old Capital, James, basically you're not just getting a loan, but you're getting a lot of education, guidance, hand holding, and so on. And if I have to talk a little bit about how I was able to make about my 8 units was about 145% ROI, and the 37 units is about 170% ROI in less than in about 2 years. It's primarily buying Class B, Class C deals, doing value addition, bumping up your rents. That's the model we've used, and also in 2016, after I sold my 8 units, I bought another 24 units. This one is basically, as you can see, purchased in December 2016 for a price of $1 million, and we actually sold this in July 2018. That's like a month ago, and I'm in another 1031 exchange again. I'm in contract on 2 different properties now, and again these are these loans are also being facilitated by Old Capital, James Eng. And obviously there's a reason. While we have done 3 Fannie Mae loans last time based on what we want to do with those properties, those are in prime locations, and probably we want to keep that for long term, and that's the reason we went for Fannie Mae loans on these. But whereas now, if you look at this right now, sold 24 and in contract on 58 units. And with these, we see a lot of value addition. So we didn't want to get locked in a Fannie Mae loan for long term. So we are proceeding with the bank loan on this right now. So now let me turn this over to James Eng.
Thanks, Satya. If you could just hang out for a second. I'm going to wrap up and then we'll get into the Q&A. So a lot of people are familiar with us, but Old Capital is a commercial mortgage broker. So we find the best lender for the transaction. So one that can close on time, on the loan terms presented. And so we look at the property's occupancy, your experience, the submarket, loan size, and choose the best lender for your transaction. So whether it's Fannie, Freddie, local bank, we close over 20 loans a month, so we know what the best lender for your transaction is going to be. And so why do investors choose us? Number one is execution certainty. So in 2018, we'll close over $1 billion in loans. I've closed about 200 million year to date. On the right-hand side of the slide, you can see about 20 of the loans that I've closed so far. And a majority of these deals are just, standard suburban B and C deals across the US. I mean, that is sort of our bread and butter of what we focus on. The second reason that people use us is the best loan terms. So we meet with these lenders every week to sort of figure out what's going on in Fannie Mae's buckets and Freddie Mac's buckets. What are the most aggressive lenders doing? How can we get you the best rates? And we are going to go back to the same lenders, and they'll get repeat business from us versus just one time with an investor. So there's a lot of lending options out there. So we know them all and help you sort of do that upfront work for you. And the third thing is saving you time. So that's what this webinar is all about, in terms of once you've signed, imagine you sign a contract and you go from bank to bank trying to find the right lender. You're in week 2, week 3, week 4 of the process. You're just too far behind the ball, and there's no way that you're going to close in 60 days. And so we know the correct lender up front. We get that person on board right at the beginning, and we know they can close based on the occupancy, the submarket, and your experience level. And so the fourth reason really is the experience of our team. So I'm a former underwriter. We have a lot of people who have been in the business for 5, 10, 15, 20 years. And, at GE, I underwrote over $750 million in loans. I've been the underwriter. I've been that guy on the other side of the table. And so I know what the bank needs, sort of when they need it and why they need it. And so making sure that you are presented in the best light. And then number 5 is inside information. So in Dallas, we are definitely a specialist. 1 out of every 3 apartment loans go through us. So we've seen it all. We talk to listing brokers daily. So when you submit an offer with our term sheet, they understand that we've reviewed your sponsorship group and that you will close. All right. So if that all sounds great, and the ways to connect with us are really, number 1, the podcast. And so if you search Old Capital Real Estate Investing Podcast, you can subscribe. We have over 150 interviews there. And then our Facebook page is a relatively new thing, but I think it's pretty powerful. We probably have 25, 30 videos on there. We record our lunch and learns there. We also, any speaker series type of stuff we have. And then whenever we are on site at properties, we try to do a couple videos for you to see what's going on in the market today. And then the third way really is our conference. So Thursday, September 13th, AT&T Stadium, we'll be sitting in the stands there looking at the Jumbotron. And right now we have over 500 people registered to attend. So this will be the top listing brokers in Texas, lenders, property managers, and owners. And then the keynote will wrap up with Roger Staubach. And so that is a huge event, one time, once a year, that we do at Old Capital. So you can register at oldcapitalpodcast.com, or when we send the slides out, this link will also be there directly to the Eventbrite. And I wanted to actually highlight one part of the conference that is different than last year's. After lunch, we're going to have a speed networking portion, and during this portion,
you will either be in the blue section or silver section, and it will allow you to go and actually talk with the listing brokers, the property managers, guys that you really need to be on your team, and that you need to get to know them and they need to get to know you. And so here is sort of our sample speed networking chart for now. And we're going to refine this over the next couple weeks, but I wanted to just give you an idea of the number of people that are going to be attending this event, and then also the number of people that you can meet. And so I think this is a key aspect. I go to a lot of conferences, and a lot of times the speakers will be on the stage for 5 minutes or 10 minutes, and then they're off and you never get a chance to talk to them. So the difference with this conference is really going to be, not only do you get to hear from them for about an hour on the stage, but then they're in the speed networking piece. You can actually go up, talk to them, get to know them, let them to get to know you and sort of what you're about. And so I wanted to go into the Q&A now. And so if you have any questions, you can put them in the chat box, and then I will address them as they come in. And so give me a minute here and I will review the questions. So the first question is going back to the searches. So a lot of times when the key principles are determined, so the people who have management control and or have more than 20% ownership, the searches that are run by the lender are typically litigation, bankruptcy, anything that would come up on your sort of credit history, that's going to be pulled by the lender. And so if there's anything that's really happened in the last 10 years, those items are going to come up. And so you need to be prepared to explain anything that comes up in those situations. And so that occurs before the locking the rate. Second question, if the deal falls apart, is the good faith deposit refundable? So this goes back to the section we were talking about, locking the rate, and you're having to put up 1 to 2%. And so on 99% of the deals I've done, that good faith deposit, there hasn't been any issue because we've locked the rate, sent in a good faith deposit, locked the rate, and then we closed 1 to 2 days later. The one deal that did have an issue was we did the good faith deposit, we're about to fund the loan, and title calls us and says that the seller does not have a payoff on the loan, so he cannot offer clear title. And so we did not end up closing that loan, and the good faith deposit was lost. And so when you go to lock your rate, you need to be 100% sure that, number one, the seller can pay off their loan, but number two, you have clear title, and three, you have enough equity to close this deal. Because typically there's a window of anywhere from probably 2 weeks to 4 weeks where after you've locked the rate, they're going to hold it for that period of time and you need to close. So making sure before you send that good faith deposit that you got all your ducks in a row and you're ready to close, the lender's ready to close, and title's ready to close. Let's see, number 3. So how is the closing process different for an assumption? So this is coming up more and more as a lot of people already have Fannie Mae loans on their properties. And instead of offering free and clear, they're offering an assumption. And then this process is typically longer. So I've closed some assumptions in less than 60 days, but most are anywhere from 60 to 75 days on the assumption. And most people are adding a supplemental as well. So the process is similar in that you order third-party reports, you've got to submit all of your due diligence as well, but the difference is that it is going through a different part of the bank. So they have a front office that's really doing new debt, and there's sort of more of an asset management function that is doing assumptions and supplementals. So the timing process is very similar, but the timing is a little bit slower. And so I would build in enough time. I've seen people who have built into their contract, if there is a loan assumption, that they will have in their contract that after the loan is approved, the loan assumption is approved, then they have 15 days to close. And so build it in that if the lender is dragging their feet and it's taking 90 days to get the loan assumption approved, then you have 15 days after that. And so making sure that you do not have a ton of hard money up front and you do not have a short window with no extensions, or you could be in trouble on an assumption supplemental where it's not really your fault. And so making sure you build in some of those things into the contract is key. Number 4, how's the loan process different for a bank loan? So the bank loans are typically a lot quicker. They can close in about 30 days. They do not have as many reports. You're not going to be doing a green report. You're typically only doing an appraisal and sometimes an engineering report. And so you can close in closer to 30 days on a bank loan. Number 4, how quick can Fannie or Freddie close? Have you ever seen them close sooner than 45 days? So Fannie and Freddie, the standard answer is 60 days. I've done loans right at 45 days, but essentially everybody is running full speed the whole time for 45 days. No issues come up, no approval issues, nothing, everything is super smooth. So I would say 45 days is the minimum on a Fannie or Freddie deal. Next question is, what are the most common items / issues that delay a closing? So usually, honestly, the last thing that happens is loan approval, but other things that can delay it are insurance. So insurance is a long lead time item. It can take 3 or 4 weeks to get the initial quote. Once you get the initial quote, you send it into the lender. The lender has feedback, goes back to the insurance company. They have to go back to get the updated accords, get a new quote, and then come back to the lender for approval. So that is probably the most common delay, is insurance that's holding up a deal. Next question is, can you estimate closing costs for us? And the easiest way to estimate closing costs is really build in, I typically say 3% of the loan amount is a good rule of thumb, and that does not include escrows. So closing costs is different than escrows. So closing costs are items that are paid and you're getting, and they are going out at closing, and they are not being escrowed with the lender. So it's two separate things. Closing cost, I like to, so typically it's 1% from the lender, 1% for legal, third parties, and title. And then if you have any type of broker representation, that is typically another 1%. And so 3% is a good rule of thumb. If you get over $10 million in loan amount, it could be 2.5% or 2%. But most people are using 3% as a good rule of thumb. So I had a couple questions come in for Satya. So let me ask the question, and then if Satya wants to answer it. Did the 1031 fund 100% of the equity for your new acquisitions, or did you have a partner?
I did not have a partner, but it did not cover 100% of the acquisition, and we have to come up with the rest of the money, and we didn't have an issue to putting up that additional money required to close the deals.
Okay, and then so on your first couple deals, why did you do a bank loan versus a Fannie Freddie loan?
Yeah, I guess initially it could be either by choice, but for my initial deals, the first property, the 37 unit, the property itself did not qualify for Fannie, or Freddie loan. And considering that I'm very new, I think on a resume side as well, it was going to hit an issue. On my first deal, even for a bank loan, bank asked me for a business plan, what I was going to do to the property, so on. So obviously I had to start somewhere. I didn't mind starting with a bank loan. But for the later on, as you saw, I sold my 37 units and we jumped into 3 Fannie Mae loans. There, the idea was that we were going to hold those properties a little longer. They're stable in great locations. I wanted to use them for my cash flow. So that's the reason we did the Fannie Mae loans on those. But on recent, the ones, the 2 deals I'm in contract, the reason for not going for Fannie was to some extent was also intentional, because those are value add properties. I plan to turn them around quickly, and I didn't want to get logged into a yield maintenance kind of situation. So that's the reason, and I think for the recent acquisitions.
Yeah, and then on those new acquisitions, the occupancy is sort of under 90%, and so there's a lot of quote unquote meat on the bone, because you can really go in there and fill those occupancies up, and then also rehab the existing units. And so once Satya is able to do that, he'll be able to either sell the deal, and the next person can do a Fannie or Freddie loan on it. And so he wants to be able to offer the deal free and clear.
Or down the road we can refinance to Fannie Mae loan if you want to keep it for long term.
Good. All right, we had some other questions come in here. How are lending standards changing with higher interest rates? There's not really, what we're seeing from Fannie Mae right now is they are staying very strict on that 125 debt service. And so they're not really changing anything. It's still the same hurdle of a 125 debt service, but the higher interest rates are moving the leverage piece lower. And so a lot of deals right now, Fannie is sort of capping out at 75% loan to cost, not because they necessarily want to, but that's just where the debt service is coming in at. So this question, what's the best loan structure for returning capital to investors? And so that is a tricky question, because you can do sort of what Satya's done. So he's gone in, he's done bank bridge loans, and then he's been able to sell those properties, offering them free and clear. And so when you return capital to the investors, that's the biggest pop. It is more risk for the general partner, but if they are confident in their business plan and that's the best loan for the property, that is one way. On larger properties, so in most of those deals, the loan size was under $5 million. But once you get into larger transactions, let's say you're doing a 10, 15, $20 million deal, most people are not comfortable signing a recourse loan for that high of amount. So they'll do a Fannie Mae loan. And one way that you are able to return capital without selling the property is to do what's called a supplemental loan. So in webinar 202, we went through supplemental loans. And so after the first year, you can do a Fannie Mae supplemental loan, and that will allow you to return equity and still keep the property. And then this last question is an easy question, so I'll take this one. It talks about does Old Capital lend outside of Texas? And absolutely we do. We're a nationwide lender. The main thing is that a majority of our deals outside of Texas are going to be focused around Fannie Mae and Freddie Mac. And so the bank recourse loan, or if you need a heavy value add bridge loan, we can do those, but we typically just do not. And so I think it's getting past 8 o'clock here. So I just wanted to wrap up with a couple things in terms of next steps. So in terms of your education, definitely subscribe to the podcast, like our Facebook page, register for our conference. I think those are 3 just things that you can do to really accelerate your learning
and improve your chances of being a successful multifamily investor. Number 2 is qualification. So complete a personal financial statement, set up time to talk with me. We'll sort of look at sort of where you are today, and then what pieces of the puzzle do you need to add either to your sponsorship group, or how can you plug in with another sponsorship group. Number 3 is start underwriting deals, understand, what areas, what submarkets you want to be in, start meeting the brokers and going on tours. And number 4, start making offers, right? So we can provide you the debt term sheet, start building relationships with other sponsors, and then start being able to provide proof of funds. And 5th is really get under contract, apply for the loan, raise the equity, and close. And so going 0 to 1 makes a huge difference. Listing brokers will start calling you versus you calling them. And so we started the webinar with this picture of everybody at the start line. This is sort of like everybody who wants to be a multifamily investor who's checking their watch and checking their underwriting on the deal. And I want to take you from the beginning of the start line to the end. And so this is how I want everyone to be, closing their first deal, celebrating. So thank you for attending tonight's webinar. Hope this has educated you on sort of how to close a deal in less than 60 days. If you need any help on a future acquisition or refinance on a multifamily property, feel free to reach out to me. Again, this is James Eng with Old Capital. Thank you very much.